Good afternoon. I'm Aninda Kara, Product Director at Global Investor Group, and it's my pleasure to welcome you back to our concluding session of today's Buyside Repo and Regulatory Forum. Continuing from our first panel of the day, where we explored buy-side market dynamics, our next panel will be discussing what the future of repo will look like. Moderating this session, I'm delighted to welcome back Bill Foley, who is founder and director of SecFinHub Limited. Bill's career spans more than 25 years and he has held various positions at investment banks before founding SecFinHub Limited in 2016. To discuss this next topic, Bill is joined by an expert panel, including Equilend, BMO Global Asset Management, GLMX, State Street Global Markets, and MarketAxess. We encourage you all to make it an interactive session and ask questions to our panel, which you can do via the Q&A function on your screen. I'd now like to hand over to Bill to get started.
Thanks, Aninda, and good morning, good afternoon, good evening, wherever you are. Thanks for joining us. So this is the final panel of the day. Earlier on this morning, if you joined us, you'll notice we were talking about, we were focusing on current market conditions. We've also had discussions around regulatory and reporting considerations. And this panel this afternoon is going to take a look into the future, hopefully, and look at what repo is going to be looking like over the next few years and some of the important considerations. We have an excellent panel, which I'm going to introduce to you now. I'm joined by Grant Davies, Head of Sales for EMEA at Equilend, Rosa Fennick, LDI Portfolio Manager at BMO Global Asset Management, Glenn Havlicek, CEO and co-founder at GLMX, Travis Keltner, Head of Financing and Analytics at State Street Global Markets, and Camille McKelvey, Head of Business Development STP at MarketAxess. So thank you to all the panel for joining me. Just catching up on some of the headlines, I guess, from this morning's session. We talked about the requirement for standardization, greater standardization, and further automation of the market, and for beneficial owners and buy-side participants to have a flexibility of approach when looking at their routes to market. We also talked about current market conditions in terms of liquidity. Usually when we come to this event in March, at the end of towards the first quarter of the year, we're still looking back at whichever spike we've experienced at the previous year end, and that didn't happen at the end of 2020 for a variety of reasons. And the sense was that whilst there are still some headwinds potentially on the horizon that might change the benign conditions in terms of liquidity in the market, they're not with us right now. So to kick off straight away on that point, Rosa, I'm going to ask you, do you agree with that verdict of where the market is right now, what that liquidity picture looks like, and maybe what are the things that are going to change the outlook as we move forward?
Thank you. Yes, I mean, I do agree with the comments from the first panel. There are bumps in the road, headwinds, as you might put it, in terms of the SLR news that we recently had. And of course, there's also the issue of around dividends. So banks weren't able to provide dividends to their investors for a short period of time, which meant that there was more liquidity, short-term liquidity, let's say, which is ideally placed on repo. And now that dividends have returned or can return, what we have seen is that rather than those being a backfill dividend, they're only dealing with current dividends. So that hasn't had a huge impact either. So yes, whilst the market seems relatively calm liquidity-wise because of the vast injection of that liquidity from central banks, that doesn't mean that there aren't potential stressors out there, as we saw last March. What I would also say is that we also have to consider the cost of repo. So yes, liquidity is one thing, access to repo is one thing, but the cost of repo is extraordinarily low at these current times due to the market being awash with liquidity. And there are potential changes to those repo spreads on the horizon, some of which could be with the tapering of QE. That means that the gross issuance is so large that it reduces the bank's opportunity set to move that collateral around and therefore make it less exciting or less of a benefit to banks to offer those repo rates. And with that change, potential change in repo levels, we could also see a return to netted or nettable repo, which is something that was very prevalent, I would say, a year ago, and is now sort of somewhat tailed off as people don't need it. So that could return. And there's also the supply and demand dynamics for repo. Now, speaking from an LDI perspective, pension funds, we obviously use a reasonable amount of leverage, which could be in the form of either a gilt repo TRS or in terms of swaps. But as pension funds cleave to their home benchmarks, which typically is a gilt discount rate, we're seeing ever more demand for the gilt type of leverage, which can mean that just explodes over the current or over the expected sort of time frame here. But on the plus side of the column, we're also seeing a number of new entrants to the market. Yes, they're the sort of existing global banks who've always provided repo liquidity and balance sheet to their clients, but we're seeing some lesser known or smaller, perhaps more regional banks who want to get in on the act, who like the look of the returns and are providing more liquidity to the market.
Okay, thanks, Rosa. One of the other areas which we touched upon, which was, I think, quite interesting, was it talks about the automation and efficiency of the thing, was perhaps the operational burden of repo and securities finance tools generally. Camille, from your perspective, how would you describe perhaps some of the current challenges around the automation or lack of automation, and what we could or should be doing? And the other point, I suppose, which was interesting from this morning's conversation as well, was there's a tendency to look at these benign market conditions and say, okay, well, you know what, if it ain't broke, then there's no need to fix it. But actually, another interpretation which was pushed was that it's the right time to sort of get your house in order. So, Camille, your thoughts on that?
Yeah, so I think there are a couple of things there, that the regulations are creeping up on us a bit. So things like CSDR, I don't know if that came up in your panel this morning, but CSDR is coming thick and fast. And so a historical back office issue, things like settlement and all those kind of processing suddenly becomes a front office issue because of the impact to P&L. And it's a significant significant impact in this case. We kind of know where we are with what the fines are going to cost, but buy-ins is a whole different ball game, and those numbers could be pretty huge. We anticipate if the regulation stays as it is. So I think you're definitely right. Now is the time to act, and I think then to get your house in order, to use your words. I think we're seeing, from our perspective, more entrants in the repo market, more buy side, and perhaps folks that are used to more automation in other markets, and then they come along to the repo market and the level of automation is perhaps not where you'd expect it to be in 2021. So yes, I think definitely now is the time, not just because of regulation, but just for this, the size of this market and the technology that we do have available to us, we should be leveraging it.
So I think, yeah, it's a good point. I think it was interesting, the discussion this morning, in that it pointed out that whilst most were in agreement with that, sometimes that seemingly obvious step to take isn't that easy to get through your internal processes, whether it's a question of resource or budgets, etc. I think, and to quote from this morning's session, sometimes the operational side of things isn't that sexy, but it's becoming sexier, which is a positive thing. So there you go.
Well, it's good for us because we're in the post-trade business. So yeah, hopefully it's becoming sexier. Yeah.
Travis, your thoughts?
Yeah, no, well, first of all, I think just first and foremost, before you even get to the cost, an all-in cost of an operating model, right, a front-to-back trading operating model, where you may not have an operations group talking to a trading desk and a trading desk not baking in the full cost of a trade, it could be a pure barrier to entry. So both Camille and Rosa talked about more market participants through a number of different mechanisms or through the investment in the right market infrastructure. I think it's important that for those that are trying to get into the market, right, that there's the options to, it's not a one size fits all kind of operating model, that the largest institutions who have scale on the buy side, it may not be affordable for smaller entrants who want to join the market. So providing tailored types of solutions, not just on the trading desk, but with the kind of front to back concept of the operating model is key if you want to expand that marketplace. You could think about a great market liquidity trading screen, but if you don't have a collateral management solution, if you don't have a settlement or matching engine, and you don't provide compliance, right? Those are things that will easily shut down a conversation.
Yeah, I think from that perspective of the vast variety of participants that we conveniently put together under the heading of the buy side, and the level of their activity means that you have to be relatively bespoke in finding the right solution for each particular case. One size doesn't fit all. Glenn, more automation was one of the features. Where would you describe where we are with automation now in that journey, and where will we be going, or where should we be going in the years to come?
Yeah, I was just listening to what Travis had to say, and sort of sparked in my head. So my first thought is sort of a macro thought, which is repo's not going away anytime soon. If you think about it as a liquidity mechanism, which allows issuers, obviously the big sovereigns, to distribute or have their debt distributed when, for example, as is the case in the US, we're throwing around $1, $2, $3 trillion, 5, 6, 7% of GDP stimulus packages. And I think the most current suggested one in the US is alleged to be financed completely with debt. That debt needs to get where it's going. And if you don't have a healthy and functioning repo space, that distribution is compromised significantly. So it's not a question of, well, is repo relevant or not repo? Is repo not relevant? It's relevant, will continue to be relevant. So that's sort of my starting backdrop. And then when we talk about the various mechanisms out there, I'll give a plug to State Street. State Street had a conference the other day. Travis spoke talking about various connectivity across collateral management, across engagement with clients, et cetera, et cetera. Repo is behind other markets, but there's a reason, in my opinion, that it is behind, and that is it's a very complicated animal, whether it is the number of variables, just look at the SFTR reporting fields, the number of variables associated with a repo transaction, the custodial and clearing mechanisms, the pricing of the collateral, et cetera, et cetera. It's a complicated animal. And so as a result, many individual, we call them ecosystems, micro ecosystems have evolved. And they all work reasonably well, if not very well, in their own context. But what we're talking about here is connecting all of those available options, whether it's RFQ, Travis talked previously about peer-to-peer, whether it's cleared repo, whether it's sponsored repo, whether, and I'm sure this will come up, though I kind of roll my eyes when I hear this sometimes, when we're talking about blockchain and digital currencies and stuff like that, it's all about connecting these ecosystems in an efficient way. And when we first started GLMX, I said to one of my colleagues in Palo Alto, was talking about how quickly we needed to respond to certain things in our system. And he said, well, this is never going to be a high-speed business. And I thought about that, and that was certainly consistent with my views back then. But I think the notion of available technology and available connective tissue means that we can make things happen more quickly and more certainly. And all of this technology is in my opinion, the end game is bringing all of these various smaller ecosystems together to make one significant and actionable ecosystem for all participants.
I just want to jump in really fast. I think that's a couple set of key points that Glenn raised as well. I think we think of repo and we think of only repo, and we think of traditional participants, traditional markets, but there's almost, if you think about a lot of entities that are in multiple products, whether it's lending, they have collateral obligations, they may even trade, derivatives. There's collateral and financing is all tied, intertwined in that. And having the ability to see your pool of assets, your cash positions, to be able to optimize and how you allocate into repo, and then how you execute repo on the back of that, there's groups of folks that are starting to look at that holistically and bringing these together, because there's real not only operational savings, there's not only scalability and streamlining the markets, there's a utilization play across multiple products that if you can get the right technology, again, from your, and I speak from a custodian where we have a lot of good data from our, that our clients possess, you can then bring it together to the front office. And there's more than just the, how are you making 1 bip or 2 bips in your repo trade today?
Yeah, I think it's a really good point. And certainly, I think there's a trend there. I'm perhaps surprised that how slow that move has been to move away from a siloed approach, where you may have a securities lending business sitting alongside, but not talking to a financing business sitting alongside, but not talking to the treasury desk and the derivatives guy. So all with a similar focus that should overlap. And actually, you can create an enormous amount of efficiency and benefit before you look at technology at all, just by taking that holistic view internally. One of the other things you spoke about, and you touch on it there in terms of deciding what the right tool, if you like, or the right approach is, was both trading venues, but also pre-trade, so electronic trading, and some of the benefits and challenges there. Grant, from your perspective, looking at pre-trade first, and maybe the trading perspective, how do you see that from an efficiency perspective, and where is the direction of travel? Where should we be going?
I mean, I think following up from what Travis just said, actually, crossing the silos is one of the most important things. These businesses have, we've said this before, so these businesses have evolved independently, whether it be fixed income repo or securities lending, but and they have different dynamics and different requirements, but it's crossing that liquidity which is really important now. But firstly, you need to see your assets and see what you've got available. So being able to look holistically at what you have available to you, what your liquidity drivers are internally within your institution, and then being able to connect, I suppose, at a trading level globally is a challenge. I mean, Glenn said at the very beginning, you wouldn't have thought of this being a fast-moving market, but the requirements are getting faster, and the need to ensure that you have the right tools available to either measure your liquidity, and liquidity comes in 2 levels. So pre-trade, we're historically, I suppose, very historically, I suppose, a short coverage lending business through Equilend, but there's an awful large pool of fixed income repo that goes through our platform for short coverage purposes. So making sure, and we're seeing a lot of that move into the electronic world now, where it probably sat outside. I think Rosa said in one of the previous panels, her business is 100% electronic. You ask the collateral financing guys, and it's probably 5% of that. So whereas you talk about securities lending, individual lines, and we can capture an enormous pool of inventory on securities lending on platforms. But then you have to think about so many components of that. So who are you trading with? Where are they connected? How's their infrastructure set up? What legal governance do you have? Your trade life cycle, STP, beautiful thing. So not as straightforward as you would think. And then you break all that down, you've got to look at the cost efficiency of your business. So look, we talk to a number of new clients as they come to market and look to enable the liquidity in their inventory pool. And breaking that down is, look, it's more complex in Europe, more complex globally than some markets. I mean, the US, you would think, is quite straightforward, but has its own unique intricacies. I think the breakdown of sub-custodian, the breakdown of different venues to transact is evolving. Look, we're evolving with that as well. We're looking at how we can convert the securities finance collateral trading world into a centralized market. So you can not only see liquidity, but you actually see price levels. So you want to be able to see where this market trades, which is very OTC in nature to date. And so when people step in, they want to be able to see where they can trade, who they can trade with. And if we break down those barriers, we encourage more participation. And I think that's the key thing here. But you step that back even further, and then standardization doesn't exist across a lot of our businesses. So you've got to start looking at what you can standardize. How you trade is, and a lot of people have attempted this, yeah. So standardized collateral schedules, dirty word, but look, some elements of that have got to come to enable maybe short date liquidity. If we can't agree that there's, that's what collateral is for protection purposes when things go wrong, yeah. If we can't agree what those standards look like and be able to use them for some level of unseen liquidity, that's a beginning, because then we can start to mobilize assets. We can start to untrap inventory across the globe and enable it to trade a lot more seamlessly. But look, the infrastructure, if you draw it out, it can be complex depending on organization, but it should be simple, and it's getting to that simple point. It's going to take a level of engagement, a level of cost, of course, because people need to change some things they do internally. And that's a hard thing to do when, Rosa mentioned it, revenues are low, yeah? So the return isn't as high as it was. Interest rates and cash injection has been low, has been heavy, so it's driven rates down. So always those times you have to invest for the future, and that's what we're looking at here, is how do we invest for the future? How do we connect liquidity, and how do we embrace change with that process? And that means the counterparties and participants need to embrace change with that, which is never necessarily going to be it's not going to give you an initial win, yeah? It's going to be a relatively evolving process, but a long-term effect is great.
Yeah, and I was going to say, it's actually interesting that the repo survey came out yesterday, the OCMA, you know, I'm sure you guys have all seen it, and I know this panel's supposed to be about looking forward, but it was the 20th anniversary year, and if anyone's interested, there's a podcast that accompanied it, which was quite interesting. But it said that, you know, looking back 20 years ago, voice broking made up, I think it was 35% of the, you know, the survey participants. Now it's something like 9%. Clearing zone, you know, CCP or true or ATS is only 30% today, and I know that doesn't include folks like Glenn's platform and others that are out there, but it just illustrates that the long way that we still have to go. If we, you know, then how many years forward are we going to have to get? If, you know, at that rate, then we'll still be talking about this in another 20 years. But let's hope we evolve a bit quicker than that.
Yeah, I think
it's a good point in terms of the automatic trading was actually back down from a high of 30% mid 2020, which was attributable in part to working from home, COVID, etc., to around about 27%. But it's an interesting one. One of the things that also came up was talking about that in terms of electronic trading venues or trading venues generally. From a buy side perspective, you're going to go to the one, maybe two at a push, where most of the liquidity is. And when you have a number of alternatives to go to, sometimes you think about the size of your business, it just doesn't stack up to go and kind of turn up to every single one, knock on the door and try and get some transactions done. So I think that was an interesting point from this morning's panel as well. Just touching on some of those points and putting them together, and again, we are forward looking. And to anyone who thinks we keep talking about as far forward as this morning's panel, this is a forward looking conversation, but thinking about some of the considerations that came up, particularly around, you know, standardization per se, automation efficiencies, etc. We asked the question indirectly, I guess, to what extent do all roads lead to clearing? And there's some inputs there around the regulatory side of things as well. And I think it's quite interesting that even the representative of LCH who was on this morning would say that wasn't was never going to be the ultimate destination for everybody. But Rosa, your thoughts on that?
Well, I would entirely agree with LCH. It is not a solution for everyone. It's a solution for the very few who meet the understandably stringent requirements to meet the model as it stands, the sponsored clearing model, you know, that you are actually a member. That is different to the swap clearing model. So the two don't really align. And even from a sort of larger pension fund perspective, who may meet those stringent requirements, there are, of course, the elements of cost to be taken into account. It is more expensive to use clearing. On the face of it, there are margin considerations. There's the cost of booking the tickets, and of course, there's the collateral use. And, you know, to the points earlier, we as the buy side, we do consider our portfolios holistically. We're not just looking at the different instruments, but also looking at the cost of the instruments and balancing them. Is it repo? Is it TRS? Is it swap? That is something that we do look at. Which bonds are we posting to the clearinghouse? So that's always at the forefront of our mind. And so even for those where central clearing would be a part of the toolkit, it's very much that it's a part of the toolkit. It is not the toolkit whole and entire. Each trade will be considered on an isolated basis as to whether this is appropriate. Does it get me a better rate than the bilateral offering at this time? And the reality is, when spreads are compressed, such as we see at the moment, well, probably bilateral is going to be winning. But in a stress scenario, then you'll see more of those specific entities who are able to access central clearing moving into that element and actually releasing some of the pressure for the long tail. I think it was, as was mentioned earlier, of the small and medium-sized schemes where this simply does not work in its current format.
Travis.
Yeah, so I think it's a really interesting kind of global, or maybe more focused in EMEA or North America case study, because each model is very unique, and some of the smallest tweaks to the model will really be a deterrent or an accelerator. So we're a GSIB bank, but we're only a $250 billion balance sheet. We try to punch above our weight by leveraging clearing dramatically, so that we can accommodate our custody and broader set of clients. And so we've fully invested in fixed sponsored clearing model, and have brought in a broad set of, to the points earlier around making it easy for the buy side to move in. We have over 1,900 funds and over 130, 40 different relationships, and more broadly, like the 25 sponsors that could be moving to 30 in just 3 years. It shows that type of model was very welcoming and accelerating, based on the it is a toolkit, but it's to some, I think it's part of the toolkit. It's more of some are overweight and some are underweight for the very right reasons. We see it as I think bringing this as a continuum of moving away from traditional tri-party bilateral repo. We see it as almost like a continuum of empowering the buy side, because if you can provide the collateral management, you can bring them into the direct or marketplace with all one of the largest treasury repo market in the world. Then you can tap that liquidity and share some of it. But I completely agree with Rosa that each model is unique, and whatever your bread and butter is, it may or may not be the right fit.
Yeah, I think you put that very well in terms of the empowerment of the buy side. I'm going to stay with you for a second, Travis, to talk about peer-to-peer and the I guess demand for that from buy side participants, and how it's growing, what you're doing, what you're seeing from your experience at State Street.
Well, if we, this is where it's as far as one size fits all, right? And we've talked about this for the buy side. You can't just say the buy side, but we do that, and when you think about, I think of going traditional. So traditional repo really there's been a big push away from that, given the last 10 years of regulatory reform. There's we go through ups and downs. Liquidity is available, liquidity is not available, but that's kind of played into some of the limitations of how you accommodate your clients. Are you accommodating your largest clients, or your more franchise clients? And I think what clearing helps you do, if you're depending again what model is, then you can broaden that, and you can create stability through regulatory cycles, through limitations to say the sell side, etc. But the natural next step, and clearing isn't, even in the sponsored model that we use in FIC, there's a limitation on asset classes. Tenors can be complicated. There's a number of, it's limited to US, even though we can accommodate over almost 20 different jurisdictions for US dollars against treasuries. But what about other forms of collateral and securities? And how can an institution almost facilitate a broader peer-to-peer marketplace? And peer-to-peer has a number of definitions, right? I think a lot of us think about it's a really, you think about some of the less D2C but more P2P trading platforms that have kind of come and gone over the last couple of years. Some people think of it as a trading platform, we kind of think about it as front to back market infrastructure. We also think about levels of kind of acceleration through indemnities, right? So you think about traditional agency lending books where there's indemnification, which helps spur the market for beneficial owners to face borrowers. But that doesn't really translate as much over to repo for some reason. And we think about that as being a way to open up markets where lenders and borrowers can come together if they have the support of an institution, but only that credit support. Other things like liquidity and leverage can happen outside of that. So I guess, and it needs to be flexible and modular. And I think to the one size fits all, there's a standardization that helps scale that you need to think about. Can you put people on a platform or program? But then at the same time, you need to be able to customize to a unique need or model or collateral schedule to a degree once you set those standards. So I think we think about a buy-side marketplace as the future of an evolution, which will complement the needs with dealer relationships and clearing. But we do think there's an opportunity to try to learn from some of the past peer-to-peer efforts and try to accelerate it with more of a kind of you almost hand it out on a golden platter, right, to your clients to say, here's everything you need. And by the way, is there an opportunity for you to pick up yield or have additional access to a broader type of collateral financing because the bank doesn't have to pay as much out of its own pocket to facilitate the trade?
So you're stripping down the process a bit to its more essential parts, if you like, and facilitating.
That's right, and you should be able to offer it. If some firm wants to say, I want to settle outside, I want to handle everything, but I want access to the market, great. Someone wants collateral management, outsourced, operations, whatever. How can you facilitate those types of things to get them on the desk?
Sure, Glenn.
Yeah, I'm listening to this, and I'm thinking about this notion of reaching across these individual micro ecosystems. Obviously, there are a lot of them out there that relate specifically to repo. And we talk about that a lot at GLMX these days. And there's a quick story. Right after the financial crisis, the Fed empowered a panel to review repo, and they did a report. And in the report, it talked about the roadblocks to effectively diversifying. So rather than quote unquote buy side, which I agree is not a single animal buy side, to traditional broker dealers, how about more of a peer-to-peer, which would diversify risk? And the Fed's report said, well, one of the challenges is that the expertise of the asset managers out there, obviously also not a single set, but the asset managers out there is not individual credit analysis of individual entities. And so I kind of stored that in the back of my brain. I was having a conversation with an asset manager on this very topic of peer-to-peer, and I said to him, asked him the question, so if you wanted to trade outside the traditional quote unquote buy side to sell side, how long would it take for you to do the analysis and get approval, say between yourselves and a household name hedge fund? And he looked at me with kind of this grin on his face and he said, never, how's never? And so with that in mind, I keep coming back to this notion of reaching across. So Travis is talking about a way of reaching across with the peer-to-peer mechanism that he's spearheading at State Street. The other way to reach across, in my opinion, is with technology, which is to create connectivity. Really what we're talking about here is effective connectivity across a wide array of complex ecosystems. And how do you do that? So it can be something like State Street intermediating in some respect or providing credit indemnification of some sort. Or it can be technology, the kinds of stuff that Grant and I are working on, and Camille, to reach across these various ecosystems so that you can make the access seamless. So if you are, I'll use gross terms, like if you're buy side type A and you need to reach across to liquidity pool B, we can try and standardize that. I think with the notion of how's never from the perspective of the asset manager to engaging a hedge fund makes it very challenging. But I do think mechanisms that allow those, buy side A against sell side B, side B against cleared repo, sponsored repo, as Rosa said, et cetera, is the way it will work. I think overarching standardization is a very, very difficult thing. I think it has to happen with connective tissue rather than creating an all new organism, if you will.
I think it's a good point. I'm going to pause there for a second, and for two reasons. One, just to remind the audience that if you have any questions, do feel free to add them on the question box on your laptop or on the bottom of the screen. And to put the first one, which we've had come in, which is does the panel see repo costs increasing with more buy-side participants entering the market and squeezing liquidity? Rosa, do you want to take that one?
Well, I mean, we sort of touched on it before, but yes, the more demand there is, it will potentially push costs up. But as I said, I also expect there to be more supply available. And also, as costs increase, I mean, we've mentioned before, repo is a pretty low margin business, especially at the moment. As those repo spreads increase, it then becomes more attractive. And even global banks may allocate more balance sheet in order to take advantage of those rates. Or as we've seen in the past, particularly where there's sort of significant differences in cross currency, is people will move balance sheet from the US or from Japan or wherever else into the UK in order to take advantage. So it should find a medium, I would say.
Work itself out broadly. I'm going to move on to the question of, we talked about efficiency, we talked about some of the connectivity from a technological perspective, but maybe from the, I guess, operational settlement side of things. Is it fair to say that sometimes the operational side of things gets, and we touched on it earlier on, post-trade isn't that sexy sometimes, but it's becoming sexier. Camille, do you think that sometimes we overlook the importance or deprioritize the importance of getting the actual basic operational side of things right? How does that manifest, if that's the case, how does that manifest itself now? And what should we be doing, or what are we doing to rectify that?
I mean, that definitely has been the case historically. That attitude that you mentioned earlier, if it's not broke, don't fix it, has certainly been seen for a very long time. And even today, we see the reasons of trades not being affirmed on T0, T1 as things as simple as the settlement instructions being wrong, or even more upsetting things like the direction of the trade being wrong, and even the counterparty. So there's still fundamental issues, and that's because I think a lot of this activity is still traded on an OTC basis, that you do have the humans inputting trades, and sometimes they do unfortunately get it wrong, and then the consequences of that are the cost downstream can pile up. I think it has been that kind of that thought process of, well, it just gets fixed further down the chain, or somebody goes in and fixes it every day, and then maybe the guy upstream, maybe the trader doesn't realize that that's happening, and there's all these other costs every time you instruct a trade out into the market. There's so many different parts, and you add it all together, and particularly as we've been talking about low margin business, there's already a low margin business. When you add all these things in as well, the cost, it almost becomes prohibitive. So there definitely needs to be an overhaul of the back office, let's say, because it ultimately reduces how much money you're spending, and ultimately will impact positively on your P&L.
And regulation forces that change. Yeah, so we've just gone through SFTR, which I've said before, it's the building blocks of a number of things. We brought a lot of the operational process together, had some more certainty. CSDR is the thing that drives it home. Yeah, so we have to get our ducks in order. People have to correct the processes they're going, otherwise they're going to get fined. They're going to get bought in, and no one wants that. Start getting involved in, getting bought in on liquid bonds is not a perfect world to be in. Yeah, so connecting liquidity and ensuring that we have not seamless straight-through processing is one of the most important things now.
I was going to add one of the, we think about the mechanisms of settlement and collateral management has really been bifurcated between DVP, traditional bilateral, or traditional kind of tri-party agents. And regulatory reform and on the tri-party, building those tri-party mechanisms out, we're really focused on the dealer side. And, there's a lot of, limitations on who can participate in traditional tri-party repo, or they may not be able to settle DVP. So is there a middle ground where can you disaggregate the value of operations, settlements, collateral management to, uniquely, do you provide a collateral validation service or some sort of compliance service? Do you strip that away from having to open up a third-party custody account and adding additional costs? So, I think obviously our institution didn't play in that reform, but those are I think questions you'd want to ask if you're providing those types of services away from the dealers, and because it's one of the most probably material challenges, to Grant's point and others points that people are making, is that they need to be overcome from a number of angles.
I'm going to switch to a couple of questions that have come in, because I think we're heading in that direction. We're talking about the regulatory side of things, and also I guess we're moving into talking about technology, which is going to take up a part of the conversation this afternoon in terms of what that can offer and what the direction of travel is there. So one question, does the panel see more or less regulation of trading and clearing in the European market following SFTR? So I guess the question is fairly self-explanatory. We've been through the pain of SFTR. It's there, it's a fact, it exists. Do you think we're going to get more of that? Are things going to be eased, or what's your view? Maybe Rosa first.
It's a pretty tough question.
I mean, I think there'll be loads of much less regulation. Seems a bold place to start from, right?
Well, I mean, there are always possibilities of more regulation. I mean, that's the reality of it. But from a clearing perspective, I don't see a push to make repo as a mandatory cleared product. I just don't see that the market's there, the market's ready for such a move, which would therefore reduce the opportunities for regulation even around that perspective, such as asking the largest market participants to move into clearing. So it's a bit of a non-answer, but it's all I've got for you at the moment.
That's quite all right. I think it's, as you say, it's a tricky question in that, it requires a bit of a crystal ball. We are forward thinking, but maybe we can't predict the future entirely accurately. Camille.
Yeah, no, I'd kind of agree with Rosa as well. I mean, we don't have a crystal ball, of course, but things like mandatory clearing that we've seen in other markets, not only is the repo market not ready for that, in my opinion, but then you've got, we're all quite comfortable with government collateral, that the kind of collateral that's eligible for clearing. But then what about all of the corporate collateral out there and the corporate bonds out there? And if somebody has to be comfortable with those kind of assets being used for clearing purposes before we can even get to the point where I think even start a conversation about mandatory clearing in repo anyway. That's my view anyway.
Fair point. Glenn, any thoughts on more or less regulation, or just about the right amount?
I think it's a fine line. It's a razor's edge in certain respects, because when governments are issuing the amount of debt that they're issuing, if they essentially kill the goose which distributes that debt with excess costs, it's a problem as I see it. The Fed the other day chose not to extend some capital breaks to some of the big institutions, and it could be and repo rates have kind of, in certain respects, are very low, close to zero. Maybe that they're priming the pump, but I think they are aware and have to be very careful about excess regulation as relates to the liquidity in these systems. And as I said, I'm sure they're aware, but it's definitely a knife's edge in my opinion.
Okay. Another question which has come in, which is talking about whether crypto offers any future potential in areas of collateral management over different ecosystems, which we could talk about for a whole day perhaps. But I think I'll tie that in, if you like, to the next question we were going to come to anyway, which is talking about technology. It's clearly going to play a significant part, a huge part, in how these markets do evolve, albeit it's fair to say that they're not particularly quick moving or haven't been very rapidly moving to date, to Glenn's point earlier on. From a technological perspective, and Glenn, I'm going to start with you because you expressed your desire to talk about DLT and blockchain earlier on, so unfortunately you're going to get picked on first. How do you see themes like digitalization, tokenization, etc.? And we can throw in AI and machine learning as well if you like. But I guess, where do you think they'll have a role? And what benefits do you think they'll bring? And how will they address some of the topics we talked about this afternoon?
Yeah. About 10 years ago in our office in Palo Alto, I was sitting down with some of our engineers, and Bitcoin, I think, was around $1.50, $1.50. And I made a bet with one of them about that it will never get to $5. So on the crypto thing, I'm the first to say that I have been skeptical, but there's a point, and people these days tend to lump together blockchain, crypto, and technology. They're all variants on a theme, in my opinion. So, look, my view is that that blockchain technology has a place, whether it's with cryptocurrencies or whether central governments issue fiat currencies in crypto form, to me, remains uncertain. I think central banks probably like their monopoly on currencies, and they have a lot of authority. So, but I don't know the answer to that. What I do know is that blockchain itself is another arrow in the quiver of making these markets more efficient. So something that I think is true, and Grant talked about CSDR, money has value and liquidity is liquid, meaning it flows, right? And if you have 100 different locks, like they unfortunately are not moving much through the Suez Canal today, but when you have 100 different locks, it's very slow to get from one side to the other. But if you create a liquid flow where there are no locks, no barriers, it's a lot smoother. So my feeling is that things like CSDR and intraday overdraft things, which have been around for a long time in the US, strongly suggest that there is value to money intraday, within the course of a day. And my feeling is that at some point there will be a market, a healthy market for intraday secured financing, borrowing and lending of cash and collateral intraday. So how do we get from here to there? Since this is a forward-looking panel, I can say stuff and probably not be held to it immediately, but let's say that there is demand for intraday financing. People who have access cash want to get paid, and people who need cash for their cap, their intraday cap or whatever, have collateral. How do we get from here to there? Well, it has to be more efficient. And something like blockchain, I think the promise that I see for it is it allows all of this stuff to speed up, to be able to see what you're doing in a very complex market. Don't get me wrong. Repo is behind other markets on the electronification, quote unquote, electronification curve, because it's more complex. With all due respect to, say, buying and selling of equity, right? You need to know the ticker, you need to know the amount, you need to know the price you're willing to pay, you need to know where to go, and the trade is done. And those electrons, the money and the security, cross in the night, game over. In repo, you have persistent credit exposure, you have multiple collateral movements, you have prices of collateral, et cetera, et cetera. So it's no surprise that repo, in my opinion, is behind in this curve. And the way that we catch up on this curve is through making the processes more efficient. And insofar as something like blockchain is concerned, I don't think it is the, Hosanna, here we are, the new world order. I think it is a piece, it is a block, a building block in the process of making these things more efficient. I'm certain that there is a use for it down the line to that end.
Look, I'll jump in there just a little bit. So, I mean, I think you mentioned crypto and digitized technology. So, look, crypto, I think cryptocurrency would only get comfortable when they understand where the source of cash is coming from, where the source of assets coming from. And until banks understand that, I mean, Credit Suisse came out and said that they were uncomfortable until that point. But from our perspective, from a distributed ledger point, it's about reducing intraday risk. Yeah. So what can we move faster? I mean, intraday repo does one element of it, but actually being able to trade and settle it like that is the other point. And we have some tools available to us, and it's using some of the traditional versus probably just evolved technology. You've got products out there already, things like HQLAX, which are looking at how they evolve that. And look, it's just it's not rocket science, yeah? It's just looking at how we look at a ledger, how we control it, how we can manage intraday liquidity and move it. Tri-party was, I suppose, the origination of that some time ago, when they looked at how we close intraday credit, how we manage DVP in a collateral world. And it's evolving beyond it now. So I think the embracement of digitized asset, tokenizing collateral is not beyond our reach, and not too far away. And I think we'll see that relatively quickly. But one of the challenges that remains is breaking it down. You digitize an asset, it needs to be recognized. Yeah. So central banks need to understand what they're getting. Yeah. So, and then using it through the chain. Yeah. Not only are you repoing in a digitized asset, you're able to place it somewhere. You're able to use it for your UMR requirements. Look at the chain of what you're doing and why you need it. And that's where all the friction sits. The friction sits is not only repo in the assets, I've then got to deliver them. It takes me time. I've got complex collateral rules. Yeah, it comes back to the point on standardization to an extent. Create an element of standardization. You create a simple liquidity and you help the process. And I know it's a challenge. Yeah, we're never going to get global standardization across everything, but I think digitized assets, tokenization will help create that to an extent. And then you get away slightly from the lots of little pieces of, especially fixed income assets where you've got fractured liquidity. You know what, you've got a categorization. And categorize an asset, digitize it, tokenize it, move it. And that should be the next evolution of our market, you would think.
I think, yeah, it's a good point. I think to your point around actual repo of or financing of crypto or digital assets of whatever flavor, the decision-making process there is as old as time. If we don't know what it is, we don't like it, we don't think it's liquid, we'll take a view on that and finance it, or we won't. And there are financing activities happening out there in cryptocurrencies and in digital assets already. But what I'm hearing is that from a benefit perspective, one of the real pros of the thing is that you will be able to transact and settle in I get this right, a digital instant. We can't say instantaneously, in a digital instant, and take out a lot of the delay and inefficiencies that go with that. So I think from an operational perspective, that's critical too. Travis, I'd be interested to get your views.
No, yeah, I think we're seeing more green shoots than ever, right, in this space, and that says something. So there's a lot of, even though it's somewhat, you kind of introduced digitization, blockchain. There was they saw the end goal, and then there was a lack of general acceptance on the end goal, but then people kind of go into denial, and then they say, and there's an equilibrium, right? So people are starting to find, how is this really going to be useful? And on two ends, I think that it's already been hit on, right? The blockchain aspect, but then the investment in these types of currencies. And we're in a marketplace now where people have no other alternatives as well, right? You see where equity markets are, at least, in some of these inflated markets. You see where debt markets are, money markets. And you're seeing people coming out saying, we're holding Bitcoin, and these are established institutions, right? And if you're holding Bitcoin, you need someone to administrate it against it. You need someone to custody. You need someone to be able to move it. And eventually, you're going to need people, as more and more people do this, you're going to need people to create liquidity off of it and to be able to transact off of it and make payments. And the venue you create for that, and how you is there a smart way to create these small pockets where you're bringing that together, which eventually merge? I think you're right. Like, to Glenn's point, like, maybe this isn't today, but are the green shoots that could blossom, and you could have a few trees come out of that. So I think about ways of, again, going back to like empowering, leveraging technology to empower folks. Again, if you build those types of and obviously pending regulatory views and acceptance, just like we've gone from the gold standard to dollars to credit to, you know, faster ways of executing and payments and transacting, that there's a regulatory acceptance there that needs to happen, that people are starting to eventually say no, and now some people are saying yes, and there's a little bit of mixture in the air. But I do think that this is the direction we're going, and the folks that are, you know, investing in this today, you know, maybe they'll reap something, maybe they won't, but I do think over the next 5 years there's going to be movements given the amount of noise we're seeing.
Sure, I think you're right. I think that, again, the benefit seems to be the ability to settle more efficiently, more quickly, and also, I think, to touch on a point Camille made earlier on, at the margins, if you can reduce the cost and increase that efficiency through that route, then more business becomes viable and more, you know, more benefits your bottom line. And we're right on it in terms of time. We've got about 4 or 5 minutes left to go, so we're going to move it on slightly. But just to finish off the point there, we had one question. Do the panels think custodians will be able to handle intraday repo? Well, I suppose we just touched on that, because maybe they will when we move towards a digitalized world. But I guess that would be something for custodians to look into. In terms of the final question we were going to, or a final area we were going to focus on today, was around the issuance of a lot of green government bonds, ESG focus. Will we see a drive towards a green bond investment? We already seen that, but will that create green yield curves differentiating from non-green yield curves? And will we see a greenium, green premium? And what will the impact be on the repo market going forward as this becomes an ever growing and more powerful trend? Rosa, I'm going to come to you on that one.
Thank you. Well, I mean, just to put this in perspective, as an asset management firm, as a global asset management firm, we clearly have a strong ESG focus, and I've been doing a lot of work on this in all aspects of the sort of green and ESG world. So looking at the UK specifically, it's now been announced that there will be 15 billion worth of green gilts issued likely this year. We don't quite know the framework, but it's expected that they will try and build out a curve, which will also help the UK green corporate issuance grow up. But we expect the framework at the end of June. So having said that, and with lots still to be sort of found out about the UK issuance, we can infer some elements of what this could look like from the European issuance, particularly French and German. So there have been 2 ways that they've issued, which I won't go into detail given the time, but the clear approach is to try and keep the yields roughly similar. Now, that hasn't necessarily been the case, even in Germany, where you have the twin issuance, and there is a divergence in yields, and it looks as though, you know, people are actually playing in and out of the green versus the non-green, or brown, horrible phrase, version of the bond. And so you can see that, funnily enough, liquidity in the green aspects of the yield curve is actually sometimes even more liquid than the non-green yield curve, which is very interesting. But from a repo perspective, they're treated completely the same. There is no difference in repo spreads. So you can assume that potentially, all things being equal, and certainly at the start of the UK issuance, that is what you would expect. However, there could be a few changes which would impact the repo costs for green gilts in the UK. And just quickly, you know, one of those would be if money market funds, a lot of those are turning green, that's one way to put it. If they were only able to accept green bonds as collateral for those reverse repos already been mentioned as a key part of their liquidity structure, you know, that would change the demand dynamics for those green bonds. And after all, you know, banks are sitting in between the money market funds on the one side, who are reverse repoing out very short term, and, you know, the longer term buy side, such as LDI and other market participants who are looking to term out for 6 months and 1 year. So that could mean that by holding green bonds, we would be able to receive a better level by repoing those out. There's also the question of APF eligibility. You know, it could go either way. There's no real reason for them to be excluded from the APF. But particularly at the start, with 15 billion across a curve, you're going to have sub-sized bonds out there, which could in turn mean that they trade very special. Again, giving a possible differentiation in repo spreads for the green versus the non-green. And finally, and this is real blue sky thinking, is it possible? Yes, is it possible in the future that regulators would apply preferential treatment to banks holding green bonds. Will it impact their HQLA? That could be a massive game changer in terms of not just the size of the market, but also the development of the market and how much sort of related products come to be. So I think that's a really interesting sort of thing to look forward.
Yeah, I think you're right. I think even if it's not from a regulatory perspective, from a PR perspective, if there's a benefit in being very green around what we hold as HQLA, that's a great statement. We're absolutely bang on it on time. I was going to just reach out to each of you to give us 10 seconds of what you think the most important feature for your particular area would be. I'm going to start with Camille. I'm going to throw that one to you, unfortunately. There you go. 10 seconds on what you think is the biggest focus for you over the coming years.
It's just to get your ducks in a row.
Nicely done. Grant. Not being on mute, that's a good place to start.
Not being on mute is a good start. Similar, I think, getting the ducks in a row, connecting systems, STP, all the things you need to make sure this starts to work forward.
Glenn?
I just think it's the use of technology to speed processes up, complex processes up, which has been going on for generations, and now's the time.
It's a good sign. Travis?
I'd say iterating with our clients collaboratively to expand the repo marketplace.
Perfect. Last word to you, Rosa.
It would be improving efficiency and access to markets so that we can solve tomorrow's problems today.
Nicely put. Efficiency, efficiency, efficiency. I've been inefficient because we've run over time, so I can only apologise.
Good strapline. I like the end of that.
I hope that you've enjoyed that. It's been a pleasure to host the panel, and I'm going to hand it back to Aninda, and thank you all very much for your time and for your contributions. Thank you.
Thank you. Thanks, Will. I thought that was a very useful and informative session. And thanks to all of our panelists for shining the spotlight on the future of repo. I think it's fair to say that sort of market dynamics are changing and the emergence of smaller players are sort of entering the industry with more buy-side firms coming into place. So I guess the theme of today, or the overall theme, has been sort of how to get your house in order, or get yourselves ready for the future, whether that's sort of overhauling your operations, standardization, or digitalization. This will vary from firm to firm. So that brings us to the end of today's sessions. I'd like to thank all our speakers and delegates for participating. I'd also like to thank our sponsors for making this event possible. We hope that you've all enjoyed today's sessions, and if you've missed any of the panels that took place earlier, they will be available on demand. Please do join us for our next virtual event, which is the ISF South Africa Masterclass, taking place on the 20th and 22nd of April. Details of how you can register are available on our website. Thanks again for joining in today, and we look forward to seeing you at the next event. Thanks everyone. Goodbye for now.